There's so many different types of ETFs on the market that you could buy in 2026. And in this video, I'm going to be talking about 3 solid ETFs that I'm buying heavily in 2026 and why I think they're great picks. Quick reminder, this video is for educational purposes only. This is not financial advice and I'm not a financial advisor. All investments carry risk, so always be sure to do your own research before making any investment decisions. The first ETF I'm heavily buying in 2026 is SMH, the Van Eck Semiconductor ETF. SMH tracks the NVIS US-listed Semiconductor 25 Index, which invests in companies that are involved in semiconductor production and equipment. This means it has companies that designs chips, foundries which are manufacturing the chips, equipment manufacturers, and more. So basically, the whole semiconductor ecosystem in one fund. And these companies must generate at least 50% of their revenues from semiconductors or semiconductor equipment, along with having a market cap of at least $150 million and a 3-month average daily trading volume of at least $1 million. And the index is market cap weighted, so the largest companies are going to make up more of the fund. For the portfolio of SMH, this fund contains 25 stocks, with top holdings in names like NVIDIA, Taiwan Semiconductor, Broadcom, Micron Technology, ASML, and a few others that make up over 70% of the portfolio. While SMH gives you exposure to the whole semiconductor ecosystem, it's still focused on a single industry in the technology sector, so it's very concentrated in its holdings. And while it does mean it comes with increased volatility, it also comes with some serious potential growth opportunities. Getting to the cost, SMH has an expense ratio of 0.35%, costing $35 for every $10,000 invested, which isn't too bad when you account for the returns. And for the performance, SMH has really stood out with 5-year annual returns of over 29.5%, along with annual returns over the last 10 years of 33.3%. And if we zoom in more recently over the last year, it's had returns of right around 76.5%. This industry has been rapidly growing while also providing some truly amazing returns. And there's a couple of reasons why I'm heavily buying this in 2026. First is that the spending in AI and AI infrastructure doesn't look to be slowing down anytime soon, with hyperscalers like Microsoft, Meta, Google, Amazon, and Oracle planning on spending nearly $700 billion in AI capex in 2026 alone. This is huge for the companies in the semiconductor industry since a lot of that money will flow through them one way or another. Second is that the demand for semiconductors goes beyond just AI. Semiconductors are a core component in modern electronics, and they're driving advances in transportation, communications, healthcare, defense, energy, and so much more. And they play a big role in the new technologies that will transform the world going into the future. Next is that I think this year will be a great buying opportunity. So far in 2026, there's been an increase in volatility in the overall market. You can definitely see this through SMH's returns so far in 2026. It's been a bit of a roller coaster ride. With the most recent conflict in the Middle East and inflation fears, labor market worries, doubts about rate cuts, and more. This uncertainty is going to bring about much more volatility in the market. With that being said, it doesn't change my view or approach to investing in this industry over the long term, and if the price goes down, that just works out in my favor since I have a long investing time horizon. The second ETF that I'll be heavily buying is VU, the Vanguard S&P 500 ETF. VU tracks the S&P 500 index, which includes the 500 largest companies in the US. And the S&P 500 makes up roughly 80% of the total US stock market value, so you're invested in a huge chunk of the overall US stock market. This also gives you great diversification across many different companies, industries, and sectors. What I like about Vanguard funds, and especially VU, is that it comes with lower fees with an expense ratio of just 0.03%, costing you $3 yearly for every $10,000 invested. The portfolio of VU is solid as it currently has 504 holdings in its portfolio. And the top holdings are in names that you're likely familiar with, like NVIDIA, Apple, Microsoft, Amazon, and Google, and a few others, which together make up around 40% of the portfolio. So it does lean a bit more into these mega cap tech names. And the sectors it's mostly exposed to are technology, which is about a third, financials, then communication, and consumer discretionary. VU gives you a nice spread of stocks across different sectors, making it a great choice for a core fund, which for my portfolio, that's exactly its function. VU plays as my foundation, and then I add on other ETFs or stocks that fit my investing strategy to complement my portfolio. The S&P 500 has a long track record of providing great returns, with the more recent years being pretty exceptional. And by that, I mean VU's had 5-year annual returns of around 14% and annual returns over the last 10 years of nearly 15.5%, which is really solid when you think about the longer-term average of the S&P 500 being around 10.5% or so. So now let's talk about why I'm buying heavy in 2026. First is that I'm getting exposed to not only the 500 largest companies in the US, but a large majority of the US stock market in terms of value. The core component of VU is what makes it really resilient over time, and as time goes on, some companies may fall out while new companies will come in. So you'll be exposed to the largest companies of today and the ones into the future as stocks rotate in and out. And this includes a mix of companies across different sectors and industries, so diversification comes as a standard trait with this index. Second would be that while VU is a broad market ETF, it does come with a decent amount of exposure to the AI theme. Some of the largest companies in VU, like Nvidia, Microsoft, Google, Amazon, and Meta, are heavily invested in the realm of AI and AI-related technologies. So even if you aren't invested in an ETF like SMH or a tech-related fund, you're still getting some pretty meaningful exposure to AI. While I believe in the AI story and the potential within the space, I think VU is going to be able to greatly benefit from the growth in this space due to the companies it holds. And while the short-term fears around the amount of spending in AI will likely linger for the remainder of the year, that doesn't bother me since I'm looking further out into the future. The next reason is for the broad growth potential of the S&P 500. While VU is more concentrated in some of those big tech names, which have taken a small hit this year, there has been a shift to other areas of the market. And while earnings growth has been overall positive for the market, we could see more potential growth from names that are outside of the Mag 7 companies. This is just to highlight that if we see slower growth in these companies, VU could still provide some good returns for the year. Of course, this is shorter term thinking, since for the long term, I'll be buying regardless, and if the macro environment does get worse and the market does take a hit, then I'll definitely be buying the dip. And something to keep in mind is that the S&P 500 has never had negative returns when looking over a 20-year time frame. So it just goes to show, over the long run, it's hard to go wrong with being invested in the broader market. The third ETF I'm heavily buying is schg, the Charles Schwab US Large Cap Growth ETF. schg tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is made up of large cap growth companies. And these are companies that are expected to grow revenues and earnings faster than average. The growth stocks selected for this index are based on 6 measures, 2 projected, 2 current, and 2 historical. This includes projected price to earnings ratio and projected earnings growth, price to book ratio and dividend yield, then trailing revenue growth and trailing earnings growth. For the portfolio breakdown of schg, this fund contains 198 holdings, with its top holdings in companies such as Nvidia, Microsoft, Amazon, the other Mag 7 companies, Broadcom, and Eli Lilly, which make up over 50% of the fund. Because of the weight, these top companies are going to have a larger impact on the price movements of schg. For the sector exposure, probably not too much of a surprise, but technology is the highest, then communication, consumer discretionary, and the remaining percentage spread in other sectors. As for the cost, schg comes in nice and low with an expense ratio of 0.04%, costing $4 yearly per $10,000 invested. Growth stocks have done very well over the past years, which is reflected in schg, where this fund has had 5-year annual returns of around 14.5%, and annual returns over the past 10 years of over 18%, providing returns that well outpace the overall market, which has also had great returns. So why am I buying this fund heavily in 2026? First, and most important to me, is the growth potential of schg. This fund gives me exposure to companies that are expected to grow faster than the norm based on a variety of metrics, which includes innovative and high growth companies in tech and other sectors. I also have strong conviction in the Mag 7 companies to continue to provide great earnings and growth, and to continue to lead the way when it comes to AI and AI adoption. Next would be the fact that I like more exposure to growth when it comes to my portfolio. While VU holds growth stocks and the top holdings are growth leaning, it's also giving me exposure to a variety of other blended and value stocks, unlike schg, which is only concentrated on stocks with growth characteristics. So not only am I getting growth stocks that aren't in VU, for the stocks that are in both, I'm going to have a larger allocation of them in schg. This last one is that I can't pass up schg when it's discounted. Currently, year to date, schg is down by around 7% already due to a variety of factors. And when looking at the last 6 months, it's been quite a choppy ride for schg, and in the short term could possibly continue that trend. As we came into 2026, there's been a transition out of tech and high-risk assets in general, along with a lot of uncertainty, which reflects in schg's recent performance. There's currently concerns about cash flow and returns when it comes to the heavy spending in AI, high valuations, uncertainty when it comes to the labor market, Fed chair changes, rate cuts, the recent escalations in the Middle East, and more. And since growth ETFs are not the go-to funds when things are rough, I see this as an opportunity to continue buying, and if the market gets worse, then that's just an even better deal to me. Now, I want to transition to 2 other ETFs that I'll continue to invest in, but with much smaller allocations. The allocations for these ETFs are smaller, not because I don't believe in them, but because they aren't a priority in my portfolio at this point in my investing strategy. First up is schd, the Charles Schwab US Dividend Equity ETF. This fund tracks the Dow Jones US Dividend 100 Index, which invests in US companies with a track record of growing and paying dividends. It selects companies that have paid dividends for at least 10 consecutive years, along with further filtering based on dividend yield, return on equity, 5-year dividend growth rate, and more, which allows it to have a portfolio of solid dividend payers. Speaking of portfolio, schd currently has 101 holdings, with its top holdings in Lockheed Martin, ConocoPhillips, Verizon, Chevron, Bristol Myers, and more that make up around 40% of the portfolio. For the sectors, schd is exposed to: energy is up top, the consumer staples, healthcare, and industrials. schd provides some good exposure across a variety of sectors, and unlike many funds that you see now, it isn't heavy in tech at all. While it does lean more towards defensive sectors and stocks, it's quite a bit heavy in energy compared to other areas. Now, I do want to say shd's annual reconstitution is coming up this month, so we'll be seeing a shift in its portfolio. Typically, the fund changes by a decent amount, so we'll have to wait and see what stocks it ends up with and if it's still primarily energy leaning or not. For the fees, schd has an expense ratio of 0.06%, costing just $6 per $10,000 invested. And for the dividends, it comes with a dividend yield of 3.3%, which is paid out quarterly. And it's had 14 years of consecutive dividend payments, along with 14 years of consecutive dividend growth, which is every year since it was created. For the performance, schg has had annual returns over the last 5 years of 11% and annual returns over the last 10 years of over 13%, which is solid for a defensive dividend paying ETF. Now, I know schd can bring some controversy when it comes to the discussion of the best dividend ETF, but I do think that this fund does a great job in the dividend department, and it can also be a great way to add exposure to value and defensive stock. schd is all about the strategy of selecting quality dividend stocks and less so about squeezing out performance. I really like this fund, but I don't need the income right now, nor do I care to have a large allocation in funds with less growth potential. I have decades to go before retirement, but I do want to continue to slowly build out my position in this ETF, and later on in the future, I can see myself adjusting my portfolio to have a bigger allocation of this fund along with other dividend ETFs. This next one is vxus, the Vanguard Total International Stock ETF. This fund tracks the FTSE Global All Cap ex-US Index, and it invests in developed and emerging markets outside of the US. So strictly international companies, so there's no US exposure at all, and this includes small, mid, and large cap companies. For the portfolio of vxus, it's pretty loaded as it holds 8,691 stocks, and the top holdings are in Taiwan Semiconductor, ASML, Samsung, Tencent Holdings, Alibaba, and more, which make up around 11% of the portfolio. And the sector exposure mostly falls into financials, industrials, and technology. And the regions it's primarily exposed to would be Europe, emerging markets, the Pacific, and North America, which is mostly Canada. For the fees, vxus has an expense ratio of 0.05%, so not bad at all. And for the dividends, it comes with a dividend yield of around 3%, which is nice, thanks to those international stocks. International has been really picking up the pace more recently, with annual returns over the last 10 years of 10.5%, and looking closer, 3-year annual returns of 19.8%, and in the last year, it's had returns of over 39.5%, which is pretty amazing. Like schd, I don't buy heavily into international, and the reason is I just have much more conviction in the US market in general over international. I think it's a great way to maximize the diversification in your portfolio, which as of right now is not my priority. I'm invested in international through my 401k, and I don't hold any in my Roth or brokerage accounts. But I could see myself later on, closer to retirement, having more in international and just being much more balanced and diversified. But this doesn't take away the fact that international has been picking up a lot more traction due to cheaper valuations, the shift out of US stocks, and growing earnings. And with this momentum, it looks like it'll continue to hold true in the near term if geopolitical issues don't get too far out of control. Now let's talk about why I chose these ETFs and my strategy for investing. First off, I have a long investing time horizon. So the biggest advantage for me now is time in the market. For this reason, I can afford to take on more volatility and risk for higher growth potential. And if you look at the funds that I'm aiming to invest heavier into, like VU, schg, and SMH, there's definitely overlap between them, primarily between schg and VU. While schg gives you exposure to growth stocks that may not exist in VU, or are a really small percentage, it will cause you to double up in exposure to the Max 7 names like Nvidia, Microsoft, Google, and others. I understand this and I'm okay with that, as these are great companies with great moats, and if things were to change for one or some of them in the future, they'll be replaced by other great companies. And I'm okay with giving up the opportunity to increase my diversification for now for more long-term compounding growth potential. I also own a handful of stocks like Meta, Microsoft, MasterCard, Tesla, Palantir, and a few others that I've held on to for quite a few years now that I have strong conviction in. As for schd and vxus, these serve a purpose and a broader long-term view of my portfolio, as I'd like to slowly add them and increase their allocations as I get further into my investing journey to switch from growth focus to a more broad, balanced, and defensive portfolio. This means I definitely plan on having a decent chunk of my portfolio in the future made up of a few different dividend funds aside from only schd, and this could be funds like dgro, VYM, or others along those lines. And I haven't made a video going over my portfolio before, but if it's something that you'd be interested in watching, just let me know in the comments below. But this brings me to a very important point, which is that your strategy should be tailored to your situation, your risk tolerance, and your personal goals. My strategy may be the opposite of yours, and that doesn't make it any better or worse. While those are the funds that I'm buying this year, if you want to see more options beyond the ETFs that I talked about, check out this video here where I go into the 6 best ETFs to invest in for 2026. And if you enjoyed the video, don't forget to hit that like button and subscribe if you haven't already. Keep on investing, and I'll be seeing you on the next one.